Dear learners, welcome to the course on entrepreneurship development. In the last sessions, we discussed about detailed components of feasibility analysis. You are aware about financial feasibility, marketing feasibility, technical feasibility, legal feasibility, and managerial feasibilities. So these feasibility analyses are given roadmap to each and every businessman to enter into the market and do the business, right? So without a feasibility analysis, no businessman enter into the market. So what is the prospects of the concerned business, whether the public are accepting our commodity and services, and what will be the competitor strength, and whether the customers are accepting the product as it is, how we need to fix a price, affordability will be for our business or not, where we need to source a fund, owned funds, and if we are running a manufacturing concern, what kind of technology we need to import. These things clearly we discuss in the feasibility analysis chapter. Now I am going to deal about different methods of project appraisal, business plan, and techniques how we need to adopt. The techniques, perhaps you have seen in the financial management with respect to investment for the businessman. Okay, let us all move on to the slides. Yeah. What do you mean by project appraisal? Evaluating the project or evaluating the entire business activities, or how to assess the entire business activities. Mean machinery, material, money, management, market, method, whatever. Suppose if you want to evaluate the entire business, you will come to know the real picture. What is the finance value? So what will be the tenure for achieving break-even point? So what will be the probable, I mean, turnover? What will be the projected expenditure? It is purely, we call it as cost benefit analysis, right? See whether the business concern should have a viability or not, for which we are going to do some kind of assessment known as project appraisal, right? Suppose we have got different options, course of alternative, I mean actions. What kind of business we supposed to take? Provision, stationery, or food, or restaurant, or a kind of a small petty shop even, right? Whatever. So what kind of business ideas we supposed to take, right? So I don't want to tell something about manufacturing, just merely purchasing certain things, dumping into our premises, adding profit and selling immediately. I am sharing something called retail outlet, or we can take example called agencyship. Yeah, the project appraisal always helping the businessman to choose best one, right? There are number of business ideas are there which will be much affordable, much comfortable to a businessman, right? With respect to best product and services, with respect to turnover, with respect to sales volume, with respect to profit, with respect to cost volume, and everything. So accordingly, they need to choose the product, right? So see, in such a way, the project appraisal should be there. See, as we discussed in the feasibility analysis, for project appraisal, we are going to discuss about economic aspects, financial aspect, technical aspects, market aspect, managerial aspects, and the social aspects. Yeah. Economic analysis, financial analysis, technical feasibility, market analysis, managerial competence. Hope you all aware about all those things. So what is the cost to volume profit analysis? With respect to fund, how we need to make use of the fund that is called available fund, where we need to go for sourcing of funds, and what kind of technology we supposed to use. So what is the market condition? Whether we have got a situation to enter into the market or we have to wait for some time. So what is the price? What is the quantity? What is the competition, right? With respect to managerial competency, how much manpower we need to get, and rest of the things, land, labor, capital, right from the first M to last M, machinery, material, money, management, market method. So overall, how we need to take a call. See, requirements of raw material, anticipated sales, location of the enterprise to be considered, demand for the product will be estimated. These and all we dealt in economic analysis. And with respect to finance, fixed capital, working capital, on what kind of requirements we need with respect to investment for land, capital, machinery, and overall expenditures, and break-even analysis to be estimated in the financial analysis. With respect to market analysis, complete enumeration survey, sample survey, sales experience method, and life cycle segmentation analysis, through that we all come to know, and followed by that we have got technical feasibility also, right? It implies to mean the adequacy of the proposed plant and equipment. As I told you, if you are having the manufacturing or production concern, we need to go for the technology, right? Imported technology, right? Water, power, transport, etc. Servicing facility like machine shops, electric repair shops, and anti-pollution law, and availability of skilled workforce, availability of required raw material, and we need to follow the prescribed norms. So these and all we need to discuss. We need to carefully deal in the, technical feasibility, right? And see, for the last competency, management competency known as the one of the important methods of project appraisal. As I told you, talent of the promoter is taken into consideration. Why? Because see how we need to project future, right? The same time, in future, what will be the probable profit or loss to us with respect to manpower, to the technology, right? Sometimes, the project may give more profit or more revenue. At the same time, the same project won't give that much of revenue. So, which will be resulted in the loss sometime. That time, how we need to manage all those things. All right. See, if you are not having the managerial competencies, we may have chance to stuck to operate, to run the entire show. That is called crisis management. We have got all the resources, but we don't know how to make use of the resources, how to plan the resources. So these things are called the methods of project appraisal. Again, telling you just to go through economic analysis, financial analysis, market analysis, technical, and management. See, for your easy understanding, economic analysis are just to plan for the raw material, capacity utilization, projected sales, anticipated expenditure and all, and demand. With respect to finance, capital requirements for fixed or working capital. Purely, we should get to know the market situation for a successful businessman or businessman. Life cycle segmentation analysis, that is called introduction, growth, maturity, decline. We have seen something called product life cycle in marketing. So what are the different stages available, and the technical feasibility and management competence. So these are all called the techniques of project appraisal. Net present value, payback period, accounting rate of return, internal rate of return. The four techniques are available for project. There are number of techniques available project appraisal. These and all probably you have seen in the financial management, or you have studied the subject called the project management or project appraisal. Special subject we may offer in MBA as one among the specialization. So there are a lot many techniques available. I am sharing the important techniques as a sample. See what I call net present value, right? These and all purely belong to the finance concern. See, if the value is equal to the present value of all future cash flows of project, the project, initial outlay, it is very important and helpful in arriving at the decision relating to investment in a project, plans or machinery. So you have got a fund, you may have variety of ideas with respect to starting a business or like investment, where we need to go for um, investment. Project A, Project B, Project C, purely based on the viability fronts. Okay, and payback period. See, one of the simplest investment appraisal techniques in payback period, within a specific tenure, how much the revenue will be there in a specific project known as, I mean, payback period. See, look at the example. You want to buy a machine costing rupees 1 lakh. There are two options, machine A, machine B. Machine A will generate revenue of rupees 50,000, 50,000, 20,000 in a year, 1, 2, 3 subsequently, right? But project B will generate only the revenue of 30, 40, 60, 1, 2, 3 year respectively. See, according to this payback period, which project will give the or which yield the more revenue. So obviously, machine A is comparatively better than the project B or machine B, right? And internal rate of return. See, IRR is the discounting rate which brings discounted future cash flows at par. This is another method, that's it. See, according to different methods, we need to define which project yield more, right? See, it is a discounting rate at which the company will neither make a loss nor make a profit. So to predict all those things, we are stepping to the, so we can also call this internal rate of return. See, it is a metric used in financial analysis to estimate the profitability of potential investments. See, it is a discount rate which makes the net present value of all cash flows equal to zero in a discounted cash flow analysis. Friends, IRR calculations rely on the same formula as NPV does. How it works out. Keep in mind that IRR is not the actual dollar value of the project or rupee of the project. It is annual return that makes the NPV equal to zero. In general, the higher an internal rate of return, the more desirable an investment is to undertake for. See, just like that, we can't step into the project with respect to investment or with respect to revenue model, etc. See, IRR is uniform for investment of varying types and such as can be used to rank multiple prospective investment or projects on relatively even basis. Hope you are understanding. Yes, similarly, ARR, annual rate of return. So it is an accounting technique to measure profit expected for a year. Unique. What is the net accounting profit arising from the investment, right? So we invested crores and crores. What will be the return? Out of 5 lakhs, we are going to get 30 lakhs. Out of 10 crore, we are going to have 3 crores, something like that. See, the ARR formula, average annual profit after tax divided by initial investment 100. See, look at the example. A company is looking to invest in machinery to replace its malfunctioning one. A new machine which cost about rupees 4,20,000 would increase annual revenue by 2 lakhs and annual expenses by 50,000 rupees. A machine is estimated to have useful life of 12 years. So what is the durability? So based on the available machine, how long we can use for the project, for the business. See, you can ask a question. So what is the basic difference between ARR and IRR. See, as I told you, my dear friends, so when a company is presented with the option of multiple projects to invest, in the decision rule states that a company should accept the project with the highest accounting rate of return as long as the return is at least equal to the cost of capital is known as the accounting rate of return, my dear friends. So what is the fundamental difference? The main difference between ARR and IRR is the IRR is a discounted cash flow formula while ARR is a non-discounted cash flow formula. Your non-discounted cash flow formula doesn't take into consideration the present value of future cash flows which will be generated by an asset or project. Okay, friends. So with this, I am stopping the lecture about the different methods and techniques which are available for project appraisal, friends. Right? Thank you all.